Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Hyundai Motor, a strategic joint venture established in Pakistan's automotive sector in 2022, now faces a key financial challenge: determining its cost of equity. As the company considers expansion amid macroeconomic volatility, understanding its capital structure is critical for making sound investment decisions. To estimate its cost of equity, Hyundai turns to a foundational tool in financial analysis, comparable company analysis. By benchmarking against publicly listed automotive firms with similar operating profiles, the company aims to derive a reliable beta and risk premium, which feed into calculating its weighted average cost of capital, WACC. This case explores the mechanics of estimating cost of equity in emerging markets, where data availability, currency risk, and market instability add layers of complexity. It emphasizes how financial rigor and contextual awareness must work together when applying global valuation models in local settings. Hyundai Nishat's experience illustrates how even fundamental financial metrics can shape a company's trajectory, especially when market conditions demand both precision and resilience in capital planning. Hyundai Motor Private Limited, a joint venture, has been navigating Pakistan's automotive market since 2022. The challenge lies in determining the cost of equity for this privately held company to assess expansion opportunities amidst economic uncertainty. The approach involves using comparable company analysis to estimate weighted average cost of capital and cost of equity by examining publicly listed competitors. Hyundai Motor, in 2022, was at a pivotal moment in Pakistan's automotive sector. The challenge was determining the cost of equity without stock price, beta, or historical returns. This required innovative financial strategies to support expansion plans in a volatile market. Traditional valuation models, like capital asset pricing model and dividend discount model, are ineffective without market data. Instead, identify comparable publicly listed automotive companies with similar risk profiles. Use their data to estimate financial metrics for Hyundai in Pakistan, ensuring a more accurate cost of equity assessment. Pakistan's automotive market is dominated by Japanese manufacturers like Toyota, Honda, and Suzuki. The market is characterized by a price-sensitive consumer base, fluctuating import duties, and currency volatility. Hyundai's entry into this competitive landscape amidst a growing middle class necessitates a strategic financial analysis to navigate these economic challenges effectively. The analytical framework involves a two-step approach. First, identify comparable automotive companies with similar size, business model, and market presence. Next, estimate the cost of equity using the capital asset pricing model, CAPM, where the risk-free rate is based on Pakistan government bonds, beta is derived from these comparables, and the market risk premium is calculated. Collect raw betas from regional and global automotive companies, unlever these betas to eliminate financial leverage effects. Relever the beta using Hyundai Pakistan's debt-to-equity ratio to align with its capital structure, ensuring a tailored risk assessment. The comparable companies analysis yielded an average unlevered beta of 0.90. This figure was derived from companies like Suzuki Motor and Tata Motors, reflecting diverse market conditions. By applying Hyundai Pakistan's debt-to-equity ratio, we can accurately relever this beta, ensuring it aligns with the company's unique financial structure. The weighted average cost of capital, WACC, is crucial for Hyundai's expansion decisions. It combines the cost of equity derived from the capital asset pricing model and the cost of debt adjusted for the corporate tax rate. This calculation determines the minimum return needed to justify expansion, balancing equity and debt financing. Expansion scenario. A surpasses the cost of capital, yielding a positive net present value, and indicating potential shareholder value creation. Conversely, scenario B does not meet the cost of capital threshold, resulting in a negative net present value. This analysis highlights the financial viability of scenario A over scenario B for Hyundai's expansion plans. Macroeconomic risks include currency depreciation, interest rate volatility, and inflation, all impacting costs and consumer power. Regulatory risks involve changing import duties, local content requirements, and environmental compliance. Market risks encompass competitor pricing, consumer preference shifts, and supply chain disruptions. These factors are crucial for sensitivity analyses to ensure robust financial projections. Sensitivity analysis reveals a 16.8% net present value change with a 10% currency depreciation. A 5% increase in import duties results in a 14.3% net present value change. Market demand dropping by 7% affects net present value by 9.7%, while a 1% rise in cost of capital leads to a 12.5% net present value change. Mastering private company valuation without market data involves using comparable company analysis to estimate cost of equity and weighted average cost of capital. Develop capital budgeting skills tailored for emerging markets, and conduct sensitivity analysis to navigate economic uncertainties. These techniques are essential for Master of Business Administration level courses in finance, valuation, or emerging markets, enhancing practical skills in complex financial decision-making. In emerging markets like Pakistan, even global giants like Hyundai face data limitations and strategic risk. Smart financial modeling can unlock growth. Private company valuation requires creative adaptation of traditional methods, with comparable analysis providing a practical solution for cost of capital estimation. Expansion decisions must balance financial returns against macroeconomic, regulatory, and market risks unique to emerging economies. Thank you for exploring this finance-driven case with Skilled MBA. For more practical insights and case study videos, mobile +91-8 7553-00795, email support@skilledmba.com, website https://skilledmba.com